Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Dan Koh. Now, the wave of uncertainty unleashed by President Donald Trump's trade policy is certainly echoing across the economy, and it shows in the U.S. Federal Reserve's latest meeting. At the conclusion of its widely anticipated May FOMC meeting, the Feds have decided to keep interest rates at the target range of 4.25% to 4.5%, noting the risks of higher unemployment and higher inflation have risen. Now, on top of that, we've also got Singapore's biggest bank just announcing their latest set of earnings results. How did they fare, especially in light of the tariffs that are currently in play? Let's find out all of this and more with Isaac Lim, the Chief Market Strategist at Moomoo Singapore. Good morning, Isaac. How are you doing today?
Hey, good morning, Dan. I'm great. Happy to be here. Thank you for having me on the show.
Fantastic. So glad for you to join us this morning. Now, let's turn our attention first to the FOMC meeting, where we saw Federal Reserve Chair Jerome Powell saying that officials are not in a hurry to adjust interest rates, adding that tariffs could lead to higher inflation and unemployment. So they kept their rates unchanged at a target range of 4.25% to 4.5%. So tell us your thoughts on the Fed's latest rate decision results and what were some of the main takeaways from May's meeting?
You summarized it really well, Dan. I think the very fact that the Federal Reserve kept rates unchanged, this was very, very much expected by the market. In fact, there was, I think it was like a 3% chance only of cut in rates. Right now, just to be a bit more forward-looking, I think what the markets are expecting is really sometime in July, right? There could very well be a cut in rate, but that's only about 62% probability. Right. And I think, we need to look at things in a bigger picture, right, in a wider context. I know ongoing there is the 90-day pause on Trump's tariffs, right? But having said that, there is a very U.S. Fed Chair Jerome Powell is really caught in between two hard places, right?
Yeah.
He's really stuck. On one end, he has to balance Trump's tariffs spillover effects. On the other end, if we were to rewind the clock back to December 2024, right, he did say that, okay, inflation is coming down, Federal Reserve is going to start easing, we're going to try to bring rates down. So that was him already putting the commitment out, right? So the market at the start of 2025 expected the Federal Reserve to start bringing rates down. But with Donald Trump tariffs, that really threw everything out the window. And we can now see with his latest press release last night, early this morning, is that, his tone has changed, right? Yeah. He has said that, we are no longer in a rush to change, to cut rates, right? We want to continue to monitor the situation given the current circumstances. And he has also, what is telling is that he did not rule out, right, the fact that the U.S. Federal Reserve could possibly also hike rates.
Yeah.
Right. He did say that they are watching inflation very carefully. And FOMC meeting last night aside, right, if we were to just rewind just to last week, right, Friday's non-farm payroll U.S. labor data, you actually see that the U.S. labor market is still very robust, right? Unemployment numbers kept unchanged, and then non-farm payroll increased, beating market expectations as well. Yeah. So here we have a U.S. labor market that is robust, right, despite pricing in higher inflation. And then on the other hand, you have Jerome Powell that is committed, to try to use rates as a monetary tool to sort of battle inflation. But then on the other end of the battlefield is Trump that is, pressing ahead with his tariffs. So not an easy place to be in, not a job that I envy not a chair that I envy to sit in at the moment. Really challenging.
Certainly, and it shows a lot in his latest comment. He's saying that it's not a situation where the Feds can be preemptive because they don't actually know what the right response is to the data, and they have to wait until they see more data to at least decide on what's the next step of approach. So, Isaac, I'd like to turn your attention over to maybe about recession concerns, which have grown in some businesses reporting, pausing investment decisions given the uncertainty, like what you've mentioned, the labor market remaining resilient. So are you still pricing in the chance of a recession this year? And how should we be, reading the latest set of numbers?
Great question, Dan. I think given the recent GDP data that came out from the US, right, it shows that there was a bit of a contraction.
Yeah.
And there was Q1 2025, Q4 2024 numbers from the US side showed that GDP was already slowing. So fact of the matter is what we're looking at now is lagging data. I think Q2 2025, right, the next GDP announcement will really start showing in the April 2nd Liberation Day effects of Trump's tariffs. So I think the consensus across the board, across economists, across analysts, is that, they are all expecting the US to hit a recession this year. And it's not wrong. I mean, if you just look at the past two GDP data, it's slowing GDP and a contraction. By that definition itself, we are already sort of in a technical recession. A full-blown recession may not be the case, right? But there are already a lot of discussion going on that, what is going on in the US is more stagflationary rather than recessionary. Right. So we're going to see really, really low growth in the US, right? But at the same time, the labor market will still chuck on. However, the cost of living is going to be really, really high over there in the US. So stagflationary is the environment that we are expecting, right? Not so much a full-blown recession.
All right. Okay. Now, with that in mind, then, what are your rate cut expectations for the rest of 2025?
That is as good as anyone guess, right? I wish I had a crystal. I really wish I had a crystal ball for that. Just 2 weeks ago, I was looking at the data and looking across my Bloomberg. I think by October or September, there was a 99% chance of at least one rate cut. But right now, I'm not even seeing a chance of a rate cut by September, right? Maybe Q4 in 2025, we might see a rate cut, right? But again, then this is running the narrative that the Federal Reserve is still looking forward to its rate cutting cycle. We might very well be taken for surprise, given how things develop, that there might be a rate hike instead of a rate cut.
Oh dear, let's hope that doesn't happen.
Sorry, Dan. But just to really give you an answer, right? I think we will see at least one rate cut by the end of this year.
Oh, okay. Well, that's very hopeful. Thanks a lot for sharing with us, Isaac. Now let's bring this conversation closer to home and look at DBS's recent earnings report, which revealed a fall in net profit for the first quarter due to higher tax expenses, which what's to be expected, right? 15%, global minimum tax that has been implemented just recently. So walk us through the latest set of results from DBS and what were some of the main growth drivers and weaknesses?
I think DBS results was very much in line with how I expected it to be. I think they did better than what the markets expected, right? So, but having said that, they did not really super outperform what analyst estimates, right? I think they just beat the average analyst estimates. So I think what is interesting to watch is really the profitability metrics, right? We see a net income of 2.9 billion, even though it is slight decrease year on year, like you rightly mentioned, due to those reasons you earlier mentioned. But I do think that looking across the board, comparing to its peers, right? I think that DBS still stands at a very strong position. We look at its common equity tier 1 ratio, right? The CET1 coming in at 17.4% against I believe 14.7% year on year, right? So this is not too far from the estimates. This is something that I think it's good, especially when we look at the CET ratio, right? Really measures the bank's ability to absorb losses and to remain solvent. Given looking ahead, right, we definitely do see some headwinds given the current volatility and all that. So I think from the very recent earnings that they say, they did see that their lower group net interest margin would be coming in. However, this is offset by their balance sheet growth. So that is a good thing. So net, I think DBS is still very stable. I am taking a bit more time to sort of digest the numbers, right? Yeah, so based on the cost to income ratio, it's really unchanged.
Yeah.
So as you can see, they are managing their costs well.
Yeah.
In light of slower income earnings, so to say.
Yeah, and certainly it shows that, they're positioning themselves well ahead of the macroeconomic and geopolitical uncertainty they were in by making an additional general allowances of $205 million as well to strengthen reserves. And on top of that, I think investors are going to love this one. 75 cents per share of total dividend for the first quarter. That's higher than the 54 cents from the year ago period as well. So final questions, just very quickly. What's your outlook for banks then? What sort of growth forecast and warning are you forecasting for the rest of this year, Isaac?
Just before I answer your question, then I think just one more point to add on to what you've just said. This dividend per share that DBS just announced.
Yeah.
Definitely, it's not just about making investors happy, but it's also a very strong form of signaling to say that, hey, look, we are doing our business right. We are positioned well, steady, for the headwinds to come ahead. So having said that, right, that brings me to the second part of your question then, which is really what I see for the Singapore financials ahead. I think all in, definitely we can expect to hold steady, right? Across the board, DBS, UOB, OCBC, they are still doing relatively well, right? If we were to look at, the FTSE Financial Index, right, for the year, right, we are still coming in with slightly higher than average returns.
Wow.
So that is a good thing, given the major whipsaws in the market, especially over March to April, right? The very fact that Singapore financials could climb and do this recovery is something to I think point out, right? That our financials, the financial sector in Singapore is definitely still stable. Yeah. But a bit more forward-looking, I think going forward, if really like I said earlier, the markets have yet to see the real impact of Trump's Liberation Day tariffs, right? And how it impacts trade on a global scale.
Yeah.
So I think this is something that we can only wait for the lagging data to come out before we take all this into context. But definitely with all these tariffs, there will be slower growth, right? I don't think it's across the board trade. I think trade is going to start shifting to within the ASEAN region, right? And possibly with China as well. But China and US, they have their own things that they are currently settling.
That's a whole set of another thing to watch out for US and China. Yeah,
exactly.
Thank you so much for this comprehensive breakdown of what to watch out for in terms of the latest FOMC meeting, as well as, the results from DBS that was just released earlier today. We've been speaking to Isaac Lim, the Chief Market Strategist at Moomoo Singapore. Thanks for joining us this morning, Isaac.
Thanks so much for having me on the show again, Dan. Pleasure
to
be here.
Our pleasure. Thank you so much. Now, keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.